Most beginners don't actually understand order blocks, and that's why they feel confusing. If order blocks don't make sense to you, this video is for you. I'll explain what an order block really is, why price reacts to it, and how beginners should look at it without confusion or overthinking. Nothing complicated, just a clear explanation that actually makes sense. Order blocks are considered points of interest for trading opportunities. But here's the real question most traders never ask. Why do some order blocks work perfectly, while others get completely disrespected by the market? To answer this, we didn't rely on opinions. We relied on data. We backtested more than 100 order blocks across different market conditions, different structures, and different reactions. We applied multiple rules and tested different setups to see whether they actually increase the win rate or just look good on charts. And what we discovered was interesting. Order blocks do not work randomly. They work only under specific market conditions and specific reactions. An order block by itself means nothing. What matters is how the market arrives at it and how the market reacts from it. In this video, first we'll break down the basic rules and a simple, repeatable setup for trading order blocks. Then, we'll show you the results. And finally, we'll explain the exact conditions that define a high-quality order block and how you can significantly increase your win rate by filtering the low-probability ones. If you've been wondering why order blocks sometimes feel powerful and sometimes feel useless, this video will answer that. So first, let me explain some primary rules about order blocks on the chart. Let's assume the market is in an uptrend. Inside a bullish trend, you will often see a bearish candle, or sometimes multiple consecutive bearish candles forming temporarily against the trend. By themselves, these bearish candles do not mean anything. What matters is what happens next. When that bearish candle, or those consecutive bearish candles, get displaced to the upside by a strong bullish candle, that bearish area becomes an order block. For example, price is in a bullish trend. Then price forms two bearish candles. After that, a strong bullish candle displaces price higher. That bearish area is the order block. The same pattern can repeat. Another bearish candle forms within the uptrend. Price displaces higher again, and that creates another order block. Sometimes order blocks form at the very beginning of a move. For example, price sweeps sell-side liquidity, and immediately after that, a bearish candle forms and then gets aggressively displaced to the upside. That bearish candle becomes the first order block of the range. If this still feels complicated, here's the simplest way to understand it. Wherever you see a clear change in the state of delivery, there will be an order block at that candle. Next, we have three major rules for identifying a valid order block. The first rule is displacement. Displacement is important because it shows strength and intent. When consecutive candles get displaced with a strong move away, it confirms a clear change in the state of delivery. In this example, you can see an order block where there is no real displacement. I am not saying this order block will never work, but it is not high probability. You can see a lot of wicks, a lot of rejection, and the move away is not clean. The change in delivery here is weak. Now look at this second order block. Here you can clearly see strong displacement. Price moves away cleanly and decisively, and the change in the state of delivery is very clear. This type of displacement gives us a higher probability order block. The second rule is optional, but it helps if you want to trade using only order blocks without doing full top-down analysis. In this case, you simply align your order block with a higher time frame structure shift. For example, suppose you have a bullish structure shift on the 15-minute time frame. After that, you mark premium and discount and only look for bullish order blocks that form in the discount range. This alignment alone improves the quality of the setup. The third rule is that the order block must be untapped. If an order block has already been tapped, even by a single candle, and price has reacted once, there is no guarantee it will work again. It might work, or it might fail, but there is no reliability left. Here on the chart, you can see a bullish order block that gets tapped once and reacts. If price comes back into the same order block again, there is no guarantee of another reaction. That is why the rule is simple.
You should always prioritize fresh, unfilled order blocks when planning trades.
Now let me show you how we are going to use order blocks in our trading. There are basically 3 ways you can use order blocks. First, order blocks can be used as a normal entry confirmation, just like we use any other confirmation such as fair value gaps or structure shifts. You can use them after liquidity sweeps or however you already like to trade. Instead of waiting only for a fair value gap or an inverse fair value gap, you can use an order block. There is no real difference. It is simply another form of confirmation that can sometimes give you a better entry and additional confluence. Let me show you an example. Here you can see a sell-side liquidity sweep. Price manipulates lower on the lower time frame. Normally, most traders would look for a fair value gap or an inverse fair value gap here. But instead of that, you can use an order block, especially if it gives you a more discounted entry at a better price. There is nothing wrong with that. In this example, you can see an order block forming after the manipulation. If we place our entry at that order block, it is completely valid. At the end of the day, if the trade is meant to work, it will work. And if price has a reason to go higher, then no confirmation, whether it is a fair value gap or an order block, will stop it. Order blocks are not magic. They are just a tool to help you frame better entries. Second, we can use order blocks as targets as well. Suppose we are already in a trade and normally you would be targeting opposing side liquidity. Instead of doing that, I would suggest you focus on unfilled order blocks that are sitting in the premium or discount just below your main targets. Most of the time, price does not move in a straight line to the exact highs or lows you are aiming for. Price often respects these unfilled order blocks that are positioned in premium or discount, and if you ignore them, price can react from those areas and stop you out before reaching your intended target. That's why, to stay on the safer side, you should always plan your targets around order blocks that are in premium or discount according to your trade direction. For example, in this trade you can see that we first have a buy-side liquidity sweep, and price also manipulates on the lower time frame. After that manipulation, once we get any valid confirmation, here we have a change in the state of delivery, so we can place our entry on that change in state of delivery, with the stop loss placed above this high. Now, when it comes to targets, if we move to the higher time frame, I don't want you to directly target the opposing side liquidity. Instead, I want you to mark the previous range, draw out the premium and discount, and then look for any unfilled order block that is sitting inside the discount. In this case, we clearly have an order block in discount, so that becomes our target. If you watch how price reacts, you can see that price comfortably moves into our target, respects that order block, and only after that does it continue higher. This is exactly why I want you to target unfilled order blocks instead of raw highs or lows, because it significantly reduces the chances of getting stopped out unnecessarily. Now, in the end, there is one more thing I want to add. If you ever feel confused while finding a proper point of interest to plan a trade opportunity, you can use this method. It can look a little complicated at first, but in reality it is very mechanical. You don't need to align a lot of things or force too much confluence. You only need one clear condition. First, you need a 15-minute market structure shift, and it can be in any direction. Once you have that structure shift, your job is simple. If the structure shift is bearish, you mark premium order blocks, and if the structure shift is bullish, you mark discounted order blocks. After you have marked those order blocks, I want you to drop down to a lower time frame and observe how price reacts inside that order block. What you are looking for is whether price has swept any form of liquidity inside the order block on the lower time frame. It can be anything, an internal liquidity sweep, minor highs or lows, but the important condition is that price must tap into the order block and show some form of rejection as it enters the order block. Once you see that reaction, you are allowed to enter using any confirmation you personally trade from. The entry model does not matter here. The location is what matters most. Now let's look at an example to make this clear. In this example, we first get a bullish structure shift on the 15-minute time frame. After that, what I do is mark out the previous range, draw the premium and discount, and then identify any order block that is sitting in the discount. Once that order block is marked, I wait patiently for price to come back into it. As you can see, price eventually retraces and taps into the order block. Now, if I move down to the lower time frame, for example the 1 minute, I can look for any confirmation to enter. In this case, let's say we enter on a fair value gap inside the order block, with the stop loss placed below the low. Now, for targets, this is the most important part. Instead of targeting the highs or the opposing side liquidity, I want you to target unfilled order blocks that are positioned in the premium, according to the direction of your trade. So here, instead of aiming for the highs, we target an unfilled premium order block. If you watch how price reacts, you can see that price moves very cleanly into our target, respects that order block, and then, after hitting the target, it reverses and goes straight into what would have been our stop loss if we were still holding the trade. This is exactly why I always tell you to target unfilled premium and discount arrays, because they protect you from unnecessary stop-outs and allow you to exit trades at logical, respected levels, rather than emotional or obvious targets. So this is how you use order blocks in a structured and mechanical way. Order blocks are not magic. They are not guaranteed. They only work when the market gives a reason for them to work. Stop forcing trades just because an order block is present. Focus on displacement, structure, and reaction. If the market has intent, the setup will be clear. If the market does not, no confirmation will save the trade. Keep it simple. Be patient. And only trade what the market is clearly offering. If you found this video helpful, make sure to like it, share it with someone who needs it, and subscribe for more content like this. If you want to connect with me, you can join my Discord and Telegram. All the links are in the description. And if you want to learn privately from me, you can check out the mentorship link in the description. I've also left prop firm coupon codes down there if you're looking for those. That's it for this one. I'll see you in the next video.